Hey, this is Andrew Jordan from NodeWise CPA. Today I'm looking at a demo QuickBooks file for a $3 million MSP. This isn't a real client, but it's representative of the kind of financials we commonly see. And what I want to do here is very specific. I want to pretend I'm a banker evaluating your company for a growth loan, or a buyer considering whether to issue an offer. Something I often tell my advisory clients is this: they pay me a lot of money to tell them things that they don't want to hear, things that other people won't tell them. So, in that spirit, here we go. All right, so let's say that I'm a banker or I'm a potential buyer. I'm looking at your books for the first time. I'm going to tell you exactly what I see and what I notice. First of all, I'm going to look at the P&L. $3 million in sales, pretty good. Ooh, gross profit of $2 million. That's like a 65, 66%, something like that. That's really good. And a net income of almost $1 million. That's around like 30%. These are really strong numbers. I'm getting excited either to underwrite a loan or to potentially buy this company. Let's dig into it further. And here the problems start, right? One of the things to think about is these people who are using these potential financial statements to give you a loan or to buy your company, they look at financials all day long. There's certain conventions, certain ways of looking at things that they're just used to. And if you don't follow those conventions, it looks unprofessional. It's like if you send out a proposal to a client that looked sloppy or had grammar errors. That's what a lot of people unintentionally have in their financials. I'm going to show you some of the most common ones right here. First of all, great that there's revenue broken between hardware and non-hardware, labor, but man, this isn't split between recurring and non-recurring. What business owner wouldn't want to know that? I, as a potential buyer or lender, would definitely want to know that, because maybe this number is inflated from like a one-time big project. Splitting revenue between recurring and non-recurring, it's a big deal for MSPs. Next thing, when I look at this, man, that labor number looks really low. So I instantly go down and I look and I find what I often find: payroll admin, probably not really $500,000. There's probably a bunch of labor expense. There really should be labor cost of goods sold. And while I'm at it, I also often find there's like a supplies expense line that really should also be cost of goods sold. So as a buyer or as a lender, I'm excited. 60 something percent gross profit margin, that just got cut in half by the time I move these things back up where they should belong in cost of goods sold. And one of the things that happens is I'm starting to get whiplash, right? And you don't want your potential user of these financials to get whiplash. You don't want them to become frustrated using your financials and have to make all these adjustments, because one of the things it introduces is red flags, and it introduces uncertainty. And so now I'm less certain about all of your numbers because these things are in the wrong place. Next one's a big one. Ask my accountant. This account should have nothing in it. And when it has especially a big amount like this, that could swing the numbers a pretty good chunk. Who knows what's in this? I should never be sending something to an external user of financials that has something in Ask My Accountant. Go through this. These things look pretty reasonable. Payroll owner. So let's say that this is a sole proprietorship. Shouldn't have payroll owner. Let's say it's an S corporation. Should have payroll for the owner, but this number is way too low, way below reasonable compensation. So it makes me ask the question: does this person not understand their entity type and the legal requirements of being that and having reasonable compensation? Or are they aware and they just choose not to follow them? Neither one of them is a good look for someone who, again, might be loaning to you or buying this company. So don't introduce that. Don't make them ask those questions. Follow those rules. That's it kind of for the P&L. Let me jump next to the balance sheet. Again, we're keeping this quick and high level. Some of the biggest things we see: checking account, $600,000. That's a lot of cash. Why is it in one bank account? Why was there no interest income? Is this person really managing their funds really well if they had $600,000 in cash and didn't get any interest income? Or is something else going on here? Who knows? But it introduces that uncertainty even more. Another thing is, it's called checking. It's called credit card, and this is called loan payable. That's a very unprofessional way of doing it. Amateurish is how it looks. Name it the bank name, last four digits for all of those accounts. That's how they should be named. That's what people are used to seeing who are professionals in this space. Next, I see inventory. See this pretty often. That's a really little inventory amount for a company that's this size. Maybe it's right. It's also a suspiciously round dollar number, right? $10,000 exactly. And I bet if I look back through the last couple of years, this number doesn't change. Either use inventory and use it correctly, or and this is often why I recommend, don't have inventory. Because if you're under a certain dollar amount, you're not actually required by the IRS to keep track of inventory in most cases. So why do it? And especially, why do it and do it wrong? So this is wrong, probably. Next thing is accumulated depreciation. That's super low compared to equipment, or if it's zero, that means tax journal entries have probably not been recorded consistently like they should be, which now I'm going to have a tax book difference I'm going to have to figure out. That's a potential whole different problem we'll talk about separately. But you want to make sure that part of professionalism in your books and the quality of these financials is that they're matching the tax return and those entries are being made. Next thing we see fairly often is a loan or a credit card balance or something like that that has a negative balance. That means it's been overpaid. And you do rarely get that with a credit card, but with a loan, you're not going to overpay the loan. This means principal and interest in most cases. Principal and interest has not been split correctly. Again, amateurish, and it means your P&L is actually wrong. So your interest has probably been understated in a case like this. Then opening balance equity. Opening balance equity is one of those accounts that you can use, but it should never have a balance at the end of the year. This one has one. Again, amateurish. Should this really have hit an expense? Should it be an owner distribution, contribution? Who knows? Raises a bunch more questions. This has to be fixed. What you want to do is make a good impression, clean up all these things, fix them beforehand, and present good financial statements that will look really good to people. The last thing I want to mention, because this has enough things wrong with it, this cash is nice and high. The profit's nice and high, stirs up a lot of interest, right? These are really good things. I have seen a client that's even smaller than this that overstated their cash and their sales by $500,000. And the way they did it is especially if you invoice out of QuickBooks, it's easy to do this. They duplicated their sales. They duplicated their deposits in some cases. And if you go and you look at your reconciliations of your bank and your credit card, first of all, if you haven't done those, that's a whole other thing. You need to do that. Because what you'll find is if there's old uncleared items, they're oftentimes duplicates, especially if they're old uncleared deposits. And so this company had over 2 or 3 years duplicated the deposits. They invoiced out of QuickBooks, makes it pretty easy to do, and the duplicates made their cash and their sales inflate by about $500,000. Totally changed their numbers and was a really big problem. So don't let that happen to you. None of these issues alone automatically kill a deal, but taken together, they create doubt. And when a banker or a buyer has doubts, they don't necessarily tell you what's wrong. They just quietly decline the loan or they don't send you an offer letter. This is what a professional sees in the first 5 minutes. If you want to understand how your MSP would perform under that level of scrutiny, whether you're preparing to grow, seek financing, or position for a future exit, that is exactly what we evaluate inside our MSP Financial Readiness Assessment. Because strong businesses don't just grow, they face the truth early, fix what matters, and build confidence that holds up in the real world.